Welcome back to another version of Pump the Brakes. My name is Andre Beckles. My firm is Harare Wealth Management, LLC. I am an independent financial consultant. All that being said, before I go any further, welcome and please like, share, and subscribe. Most importantly, subscribe. So in the case of this particular stream, it is a different stream. We're not going to be talking about market updates. We're more or less speaking specifically about retirement planning. And actually, that will be the title, Retirement Planning Options. So with that being said, like, share, subscribe. Most importantly, subscribe. I want to thank everybody that streamed the last video and subscribe. So that means you're getting a notification and you're watching this very new video. So that being said, let's jump into the show, Retirement Planning Options. The reason that I'm doing this as a special is because the economy is an ever-changing place. And with regards to employment, people are either starting work, coming back from a layoff from work, or possibly being laid off or making new decisions about their career, maybe going independent. So there are various transitions that we all go through, and the last one being actually retirement. So with that being said, what I wanted to highlight today are three retirement vehicles, and that being the traditional IRA, the Roth IRA, and the Simplified Employee Pension Plan, aka SEP IRA. So those are three different types of IRAs that I'm going to highlight and tell you maybe some of the pros, the cons, the characteristics. And of course, you can always get back to me by either leaving a message on this YouTube video or calling me directly, however, whatever you choose. So with that being said, let's jump into it. What is an IRA? Another term for IRA is individual retirement account. So you are the individual, it is your retirement, it is your account. It is a tax-deferred account. In many senses, it can also end up being a tax-free account, and we'll go into that a little bit further. It most importantly allows you to save for retirement. It is another vehicle that allows you to increase your nest egg or your wealth over time. And if we also take a look, it has different type of attributes as to where you can allocate the assets that you are looking to invest. So the variety of asset classes can range from keeping it in cash to CDs, to equities, which are also known as stocks, to fixed income, which are also known as bonds, whether it be corporate bonds or government bonds, insurance products, such as annuities, or alternative investments. I can mention two, which would be maybe real estate or commodities. So those are some of the variety of asset classes where when you own an IRA, you can have that money invested into any of these particular investment vehicles. And there are more. These are just some that I'm mentioning. The benefits, pros or cons, let's say the pros of utilizing an IRA. It's accessible and easy to establish, not hard in any way, shape, or form. You can open one at a brokerage firm, you can open one at a bank, you can do it online within minutes. So there are various ways of establishing an account, and it's very easy to do so. It allows for diversification of investable assets. I just gave you a hint of the different asset classes. It provides tax-deferred compounding growth of your assets over time. And also, as I mentioned, and I'll go a little bit more into detail, it can also allow for tax-free distributions. You must, in many senses, leave the assets there until you're 59 and a half. There are some exemptions, but generally speaking, if you decide to take your money out of a retirement account and place it into something that is not considered a qualified account, and I'll define that later, but into another retirement vehicle, which is equal to that, then you will pay a penalty if you're under the age of 59 and a half. That's a 10% federal penalty, and then the assets that you take out will be taxed. And another pro would be that it allows you to have possible tax credits for your contributions. And I'll go into that a little bit. I kind of mentioned the con earlier. I'm going to talk about the cons of utilizing, really, if there are any, of utilizing an IRA. The assets, as I mentioned, must remain inside the account until you're 59 and a half. There are penalties for early withdrawals. For certain IRAs, there are mandatory times that you must take money out of the account. Now, it doesn't mean you have to take all of the money out. There's a period of time where the IRS says, hey, we'd like to start taxing that money. Short and long, I've had many clients that have come in over the years and say, hey, I got this notice, maybe not from you, but from my other financial institution. It's like they're telling me to take my money. They don't want my money. But it's actually what it's describing is what is called a mandatory distribution. Another term for that is your required minimum distribution. So it's generally a minimum distribution. Over the years, the time has floated from the age of 70 and a half. Last year in 2022, it was the age of 72. And for those that are looking at 2023, the age is actually 73 years old. So those are some of the pros and the cons. The IRA was actually established in 1975. And one of the main reasons was the government looked at it, government looked at it as a way to help you increase your nest egg. Another way, at that time, just not looking at pensions, not looking at, there were kind of 401ks at that time, but Social Security. So not being dependent on just those vehicles, having another vehicle. And then also there was a pro there that I mentioned, depending on how much money you make, you also had the ability to possibly get a certain type of tax credit, either a full or a partial. So those are some of the pluses. And with the traditional IRA, once again, as I mentioned, provides it's a tax deferred account that allows you to invest in different investment vehicles. And you must have earned income. What is earned income? Simply as I say it, that means that you had to have worked, or I'll talk a little bit about this a little later. If you're married, your spouse had to have worked and made a certain amount so that you can contribute to an IRA. So earned income is most importantly. If you're not working, then you can't make a contribution to an IRA. Presently, what are the contributions? The contributions for 2022, the maximum contribution was $6,000. If you were 50 and older, then you could make an additional $1,000. So in total, if you're 50 and older, the annual contribution for 2022 is $7,000. For 2023, it goes up just a little bit. The maximum for anyone under 50 is $6,500. And if you are 50 and above, you still have an extra $1,000 that you can allocate to an IRA for 2023. So in total, if you're 50 and above, the maximum contribution is $7,500. There's no age limit to establish an account, and I'll go into that in just a moment. Contributions can be, or maybe I should say, fully or partially tax deductible, depending on your financial situation. So that you will discuss with your tax preparer. You can also look at the IRS, the Internal Revenue website, which is irs.gov, and you can look and see if you qualify for, based on your adjusted gross income for the year, if you qualify for a full, partial, or no deduction. Now, if you don't qualify for a deduction, doesn't mean that you shouldn't still allocate money for retirement. You should, because there are still other benefits such as the tax deferred growth over time, which is great, meaning that you're able to put money away and not get a 1099 for either dividends or capital gains over the years, and that money is growing on a compounded basis, tax deferred. So if you're not eligible for that contribution credit, that should not deter you from allocating money into an IRA. So I took a look. I was looking at the Bureau of Labor Statistics. That's one of the government agencies. I use that particular site for a lot of data. And when we look at things, there's another key benefit of having an IRA. People change jobs a lot throughout their work time. And if we look at it, anywhere from 12 to 15 times people change jobs. Careers, anywhere from 5 to 7 times throughout their career. So you could, maybe you're an electrician and you become a plumber. Maybe you're a plumber and you become a lawyer. Whatever the case may be, people do change careers, but they also change jobs. And they may change jobs for many different reasons, either bored with where they're currently working, seeking higher income, maybe you move, whatever the case may be. Another case in point is that, you may get laid off. And the reason I'm going to mention laid off is because people actually can roll their assets or transfer their assets if they choose from their current qualified plan at work. The qualified plans such as a 401k, 403b, 457, deferred comp plan, profit sharing plan. Those are just some of the qualified plans that are available. Now, I talked about people changing jobs. I talked about them changing careers, but sometimes, things change within the economy. And looking at the Bloomberg website, many people may have been looking at recent news with the economic changes, and you hear about recent layoffs. So I took a look at some of the recent layoffs, and Alphabet also we're using one of their particular sites right now, which is also known as Google. That's the parent company. They just announced 12,000 layoffs. Amazon, 18,000 people that they announced that they're laying off. Meta, aka Facebook, 11,000. Microsoft, 10,000. Coinbase, which is in the crypto site, cryptocurrency, 2,000. Salesforce, 7,000. Twitter, 3,700. Tesla, 6,000. Now, it's not just technology where you're seeing the layoffs or changes, people being laid off and maybe going into different jobs. But you also see it in finance. Morgan Stanley, 1,600. Credit Suisse, 2,700, and 9,000 people by the end of 2025. Goldman Sachs, they're looking anywhere from 400 to 3,200. Bank of New York, 3% of their workforce, which is approximately 1,500 jobs. And as recent as the past week, Capital One said they're cutting 1,100 jobs in their IT sector. So, things do happen, and people may then decide that, hey, I want more control of my money, and I want to roll it over to my IRA. That can be done. That's an option. Another option for your retirement plan is that you can leave it with your present employer. Some people will do that, and it will remain either in the 401k, or they may offer an IRA option. Another option is also that you can roll it over to your new employer if indeed they take in assets from a previous employer. When I say assets, it's generally cash, so it's not the stock or the mutual funds. Basically, you're liquidating the plan and it's rolled over, and there are no tax consequences. So I mentioned qualified plans. So, what's a qualified plan? It's a retirement plan that adheres to satisfy the IRS laws, the Internal Revenue Code, making it eligible for certain tax benefits. So basically, they are in-kind accounts that are subject to the same tax deferred and tax coding. So that's why you can roll over assets from a 401k to an IRA. So that is what a qualified plan is. Now, just going back to some of the other characteristics of the traditional IRA, it's subject to the required minimum distributions I mentioned. If you take early withdrawals, you're subject to the minimum of a 10% federal penalty, and then all of the assets, if you're under the age of 59 and a half, and it's not a qualified early withdrawal, then you will be subject to the entire amount to normal income, earned income for the year to be taxable. So the penalty can be quite high. There are several free early IRA withdrawal options, such as, unfortunately, the death of the owner of an IRA or a qualified account. Up to $10,000, and this is a one-time lifetime limit to purchase your first home. So you can, that's considered a qualified free early withdrawal. And there are certain qualified higher educational expenses for you or your dependents. Again, speak to your qualified tax preparer or visit the irs.gov website to get information. Earlier, I touched on a topic of IRA contributions of earned income. Now, let's say, for instance, you happen to be a homemaker. A homemaker is a very important job, very important, very hard job. With that being said, you have the ability, if you're not out working and you don't have earned income, but your spouse does, then you have the ability to have a spousal IRA established for yourself. So that's for non-working spouses. You can establish an IRA, make the same type of IRA contributions, get all the benefits, and also have the money invested in various asset classes. So that is another great thing for within the IRA. There is also what's considered a custodial account or a child IRA. Many people aren't aware of this. Now, we think about our kids. Our kids may have summer jobs. They may have jobs while they're in school. Maybe they're tutoring, they're working somewhere. They may have actually started their own business. So that allows a child to open up an IRA account. And that money is invested in the same means that we spoke about earlier. They must have either a parent as the custodian or a guardian to open it. The most important thing is to remember those assets must remain there until age 59 and a half, unless they are being taken out under any other, taken out for with the option to utilize under maybe a certain early withdrawal privilege, where such as education, first-time home buyer. But otherwise, if you take it out earlier than the assets out of the account, you will be subject to early withdrawal penalties. Again, speak to your tax preparer. Also visit irs.gov. Now, that's all of the traditional IRA. I'm going to talk about next the Roth IRA, and it will have many of the same characteristics. The most important thing with the Roth IRA is that there is no, and let me repeat, there is no tax credit for the assets that you're allocating in there. So your contributions, you will not receive either a full or a partial tax credit. The reason being is when you allocate money to a Roth IRA and you leave it there for that period of time, let's say age 59 and a half again, or older, but 59 and a half so that you're not subject to any penalties. Basically, when you then take the assets out, you will be taking distributions on a tax-free basis. Let me say that again, tax-free. You will not be paying any taxes. You will not have to worry about required minimum distributions where the IRS, the government, wants you to pay taxes. So I like to say that the traditional IRA can be beneficial that I was speaking about earlier, can be beneficial for those that are looking for tax credits if it's available to them. Let's say, for instance, also those people that are seeking, well, most importantly, tax credit. Most importantly, tax credit in this particular market, or if they're looking to roll over assets just as well. Pardon me, I had a brain fog there. Now, if you roll over to your traditional, and I'll go back to the Roth in just a second, again, that's not a taxable consequence, but you can roll over to a Roth, but you will have to pay taxes first, and then everything earned thereafter will be when taken out will be tax-free. So it really depends on your tax bracket, what you're comfortable with regarding the Roth. So most people generally do it with the traditional. But back to the Roth. The Roth was created in 1997. I like to say that it was done due to the fact that if you have earned income, that was taxed. And then if you allocate it to a retirement account, it's going to be taxed again. So some people looked at it as taxation without representation, but the Roth was created. It was named after legislation by Senator Roth, and that was back in 1997. Again, no age group, tax-deferred growth, tax-free withdrawals, as long as you keep that the assets in there until you're 59 and a half. Must have earned income. Once again, that's most importantly. No mandatory requirement minimum distributions. Contribution amounts are virtually the same as the traditional. $6,000 for last year, $6,500 for this year, which is 2023. An additional $1,000. Additional $1,000 if you're 50 and over, and that's for 2022 as well as 2023. And that's really the major difference. Some people will say the Roth is suitable for those that are looking down the field and saying, hey, I don't want to pay taxes later on these assets. And maybe also more suitable for someone that is in a higher tax bracket. So they're not looking for the tax credit, but they're looking to put money away for within their retirement nest egg, and that it won't be taxable later on. The last type of IRA I'm going to talk about is the SEP IRA, also known as the Simplified Employee Pension Plan. That's been around since 1978. But before I go any further, I also want to mention once more, please like, share, and subscribe. Most importantly, subscribe to the video. So when we have these specials, it will be shot right out to your email, or if you your Google, it'll pop up there saying, hey, there's a new show that's available. And also share the video. Knowledge is free. I like to say that these shows are part of financial literacy. You may know 99% of everything that I'm talking about. You may know 1% of what I'm talking about. Whatever the case may be, it is a learning tool for everyone that listens to the video. So thank you very much for doing so. And let's jump back into the show. Simplified Employee Pension Plan, otherwise known as a SEP plan. It also is a tax-deferred retirement account that's established generally by self-employed individuals. And if we talk about self-employed individuals, just think about it. Last year, 5 million small businesses were started in the US. That's in 2022. In 2022, looking at the Department of Labor's website, there were 33.2 million small businesses in the United States. That made it roughly about 99.9. That comprised 99.9% of all American businesses, according to the Small Business Administration. So small businesses are the anchor of the U.S. economy. So this may be an option for someone such as yourself or a friend or a family member for retirement options. So back to a tax-deferred retirement account established by self-employed individuals, small business owners, and their employees should they have it. Contributions can be nearly 10 times more than can be allocated to a traditional IRA or a Roth IRA. What are the contributions, you may say? 25% of compensation up to $66,000. That's for 2023. Let me repeat that. 25% of compensation up to $66,000, whichever is lower of those two numbers. So if you multiply 25% of 100,000, and that's 25,000, well, then 25,000 versus 66,000, the lower of the two numbers, 25,000 would be the maximum contribution you can make. There's no catch-up provisions for someone that's 50 and over, so there's no extra bonus there. Employers must, if you have employers must contribute the same percentage for their employees as they do for themselves. Pardon me. So if you're doing a maximum contribution of 10% for yourself as an employer, then you have to do the same for your employees. Now, let's talk about employee eligibility. Now, there are certain requirements, and this way, it's good for the employer, say, for instance, for people that are part-time employees that aren't really working that much, so they don't have to contribute for absolutely everyone. But for those other people that are there working many more hours, they will have to contribute for them. So let's look at some of the options that are there as far as employee eligibility for the SEP IRA. The employee must be 21 years of age or older, have worked at least 3 out of the last 5 years and made a minimum of $650 in 2022 and $750 in 2023. The employee owns and controls 100% of the assets that are inside the retirement account. Another word for that is vesting. There is usually, let's say if you're in a 401k plan, there may be a vesting schedule over 5 years, meaning 20% of what the company contributes, not your money, but what the company contributes will be yours. And then the next year, it's another 20%. So now you're up to 40, so on and so forth, until you've reached 5 years and everything inside there is 100% yours. So in the case of the SEP IRA, everything that's there is the employee. So that's a great thing for the employee. The employer contributions are flexible. They're not mandatory. That's the employer contributions are flexible and they're not mandatory, must not be made every single year. So if this year, $5,000 was contributed to the plan, doesn't mean that it's mandatory to do the same next year. There is no Roth component, so there's no tax-free component. Assets, as I mentioned earlier, will be taxed once distributions are made. And once again, that's 59.5. There's mandatory required minimum distributions inside these plans at age 73 based on the new IRS rules for 2023. SEP IRA employer benefits. So let's talk about some of the employer benefits. The employer may be eligible for tax credits up to $5,000 for 3 years for ordinary and necessary cost of starting up or establishing the plan. A tax credit basically is the amount of money, amount of money, I should say, that reduces the income of the company. So that's basically what your tax credit is. Again, before you look to establish a SEP IRA, speak to your tax preparer, tax planner, and also visit, as I mentioned, irs.gov so that you can have a well-rounded bit of information regarding the plans. And here is where we're going to close. We're talking about contribution deadlines. Before I do that again, I will mention, please like, share, and subscribe to this video. Contribution deadlines are basically the same as your deadlines for filing taxes. Normally April 15th, and as we're filing for this year, for last year, the deadline is April 18th. So for the traditional, for the Roth, and for the SEP plan, the deadline to make contributions would be April 18th. Don't wait for the last day, though. So that is, that is the total picture of what I call retirement plan options. Now, I must do some disclaimers. My broker-dealer, LPL Financial, I'm sure I'll have a disclaimer about the video, as I have with all videos, but I also have a verbal disclosure. Please consult, as I've been mentioning, your legal, your tax, your accounting professional for all advice. This vlog made by me, Andre Beckles, my company, Harare Wealth Management, via my broker-dealer, LPL Financial. None of us, or neither entity, I should say, is a legal or tax or accounting advisor. So please consult where necessary. You have choices where and what to do with your employer retirement sponsor accounts, as well as what you can do with your IRA. So depending on your financial circumstances, needs, goals, you may choose to roll over to an IRA, or convert an IRA to a Roth, or roll over to your new employee retirement sponsored plan, or take distributions, or leave it where it is. Those are your choices. Each choice may differ based on investment choices, fees, services, withdrawal options, required minimum distributions, and tax treatment. So that's the legalese. Again, the show is Pump the Brakes. My name is Andre Beckles. My company is Harare Wealth Management. I hope that you found this information very educational. If you have any questions, you can do so by either contacting me directly, or you can also, in this video, you can leave information there. So until the next time we speak, love, peace, and happiness. Take care of yourself. Till then, cheers.